Mr. Sandeep Maheshwari needs no introductions. He is an entrepreneur and a seasoned veteran of YouTube. For more than a decade, he has been educating the masses on a wide variety of topics. In two of his recent videos, he talked in detail about his investment philosophy, and he also talked about a mysterious bank in which he is heavily invested. From his second video, it became obvious to me which bank he was talking about. But he did not want to name the stock, so it would be unethical for me to tell you the name. Apart from the name of the stock, there is a lot to learn. This is a case of just using your common sense to create massive wealth. In the stock market, common sense easily beats high IQ. People with high IQs often perform terribly in the stock market. In this video, I'll try to analyze Mr. Maheshwari's investment strategy, and we'll find out what retail investors like you and me can learn from that. And if you want to become an early investor in this microcap channel, please subscribe. Namaste and welcome to Retail Investing. Albert Einstein said that compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. This is evident from the fact that people take so much credit card debt without having any qualms about it. The reason for that is most people are clueless about the power of compounding. The typical credit card debt holder usually pays around 36% compound interest. According to Mr. Einstein, if this person understood the power of compounding, he would be earning it. If he really earned 36% compound interest annually, let's say on a capital of 10 lakh rupees, can you guess how much money he would have after a period of 30 years? If I tell you the number, it might sound like a scam to you. So please count from the screenshot and type in the comment section. Our minds evolved to do linear thinking, and that's why exponential growth defies logic. Understanding the power of compounding is the prerequisite for coming into the stock market. Without the power of compounding, the stock market would not be different from any other market like a shopping mall. The power of compounding is based on a very simple concept. A little growth should become fuel for future growth. That can happen only if you don't interrupt your portfolio unnecessarily. And some influencers are trying to teach you their so-called profit booking strategies, which will give you absolutely no chance at compounding. And they're even charging money for that. Mr. Maheshwari has primarily two stocks in his portfolio. The first one is Images Bazaar, in which he holds a controlling stake, and the second one is this mid-cap bank in which he holds a non-controlling stake. An important thing for retail investors to understand here is that he considers himself owner in both businesses. In case of Images Bazaar, it's obvious because he started the business. In case of this mid-cap bank, he is not a founder, but still it is very important to think like an owner. The best perspective from which a business can be understood is from the perspective of the business's owners. So the presence of only two stocks in his portfolio makes it extremely concentrated. This is a case of what is called putting all your eggs in one basket. In finance, there is a theory called the modern portfolio theory, which recommends diversification into several stocks, sectors and asset classes for reducing risks. This theory was created by very high IQ people. Common sense tells me that in many cases it could be risky to put your eggs in many baskets instead of just one, especially if you understand that one basket extremely well. Imagine that one basket is made of steel with nice cushioning inside, and it is kept inside a fort guarded by a strong army which is led by a very able commander, and that fort is surrounded by deep waters with crocodiles in it. Common sense tells me that fort is the safest place to put all my eggs. That is the concept of a business moat. Investing into businesses with strong moats is a better way of reducing risks than diversification. And this is the concept of low risk, high return investing. However, diversification would be a better option for those who don't have the understanding of a business moat. When I was just getting started with investing, my circle of competence was just a dot. As I studied more and more, the dot became a small circle and it's expanding. Common sense tells us only to invest in those businesses which fall inside this circle. Mr. Maheshwari is humble enough to accept the fact that only banks fall inside this circle. He avoided hot stocks in hot industries which are mostly high-tech businesses and are highly unpredictable. He chose a regular old-fashioned bank instead of a futuristic coin that little kids are minting on their graphics cards and calling it the future currency. This bank happily deals in regular fiat currency printed by the Reserve Bank, and this bank does not deal with a hi-fi technology which they call a decentralized ledger across a peer-to-peer network. Whenever I hear high-tech words like those, I run away. It has saved me a lot of money. The concept of circle of competence is closely related to finding the intrinsic value of a business. Intrinsic value is all about future cash flows, and we can predict the future cash flows only if the business is within our circle of competence, meaning we should be able to understand what opportunities and threats could come in the future. The business of this mid-cap bank is simple enough for everybody to understand. They borrow money at some interest rates and they lend it out at higher interest rates, and the difference is their profit. The first thing that this relatively new bank needs to do is to increase its deposits very fast. To do that, the bank has to offer higher interest rates than other banks. For example, the State Bank of India pays under 3% interest rates to its savings account holders. Mr. Maheshwari's bank pays 7% or more, and that is going to entice most of the new customers. Plus, the minimum balance to be maintained in the savings account is quite high, which will result in very fast growth in CASA. This would also give the bank higher deposit per customer, and the customers acquired would have higher purchasing power. It would be easier and safer to sell them loans in the future. As long as the bank keeps paying high interest rates to its savings account holders, its net interest income will be a little bit lower. But afterwards, when it has acquired enough customers and it has become a trusted brand, the bank will slowly reduce the interest rates paid to the savings account holders. That would reduce interest expenses and increase profits. The fast growth of the Indian economy is fueled by sectors which require a lot of credit. So banks have a big role to play over the next decade. Till now, inflation and interest rates are quite high, which are not conducive for banks. By 2024, this problem is expected to subside. All this creates room for significant future growth for the banks. Another positive thing for the banking sector is that the union government is quite proactive in dealing with risks to the banks. For example, earlier this year, some tax benefits for debt mutual funds were removed. It was done to prevent the flow of money to debt mutual funds and increase deposits in banks. It was a time when several international banks were collapsing. The government's move was proactive to keep Indian banks far away from any such dangers. Mr. Maheshwari also talked about the importance of understanding valuations. For example, price to book value is a very easy way of getting a basic idea of a bank's valuation. In capital markets, big money often flows into the hot sectors of the day, and that creates undervalued opportunities in other sectors. Mr. Maheshwari has a clear goal in his mind with this investment. I think that is very important. This particular mid-cap bank is capable of growing at CAGR of 25% or more over the next 10 years and can easily multiply investors' wealth by 10 times. However, retail investors should always remember that just because we need a growth of 25% CAGR does not mean that the market feels obligated to give us that return. We need to study and research a lot to find low risk and high return companies. Until we don't find them, it's better to sit back and relax. Thank you very much for watching, and I'll see you in the next one. Jai Hind.